fiat money or paper money is manufactured. So you don't get money without debt. And the economy is not growing, if it's growing at all. And I have my doubts about that because, remember, GDP is really in part a function of inflation. And if the government is not giving us the straight inflation numbers, and I don't believe for a minute that they are, I believe inflation is at least probably 6 or 7%, then we're probably in a recession, never really have come out of it. But the point is that debt is still growing very rapidly, and we've seen a very, very minor correction so far. This bull market, this credit system will be back in balance when we see some sort of a more normal relationship between total debt and income. And I think we're a long, long ways away from that. How it's going to be resolved is the issue. This is just another picture of the same thing. It shows total debt to GDP, and we are by far the highest that we've ever been in our history, far worse than 1933, when a collapse in income, a collapse in GDP was really the reason for this raise in this ratio. So we have so much debt and so little income to service it with. But what's on the books is just part of the story. I had Lawrence Kotlikoff, who was he's been on my radio show. He was an advisor to President Clinton. He and another professor tried to get the Clinton administration to come out and come clean with the American people with respect to what our state of affairs really are. The off-balance sheet, Medicare and Social Security, you run a present value on that, and it's something like $202 trillion. This is John Williams, an inflationist economist who's also been on my show, has talked about it's absolutely impossible. There's going to come a day in the not-too-distant future when if 100% of our incomes are taxed, it will not be sufficient to pay for all of the debt that the government is on the books for. So the big question is, how do we resolve this? How is that gap between GDP and debt going to be resolved? Is it going to come through a collapse of the dollar and hyperinflation, like a lot of people believe? John Williams, a lot of the speakers here, Alex McDougall, who's going to be speaking here, I think, later today or tomorrow, will tell you, I think, that he believes that hyperinflation. Or are we going to see a massive deflation and a stronger dollar? Or at least a massive deflation. Ian Gordon would be on the massive deflation side, for example. And I remain sort of agnostic on this question because I really don't know which way it's going to go. I believe we're going for a deflationary resolution of it, but I don't know for sure. So I put something together called my Inflation-Deflation Watch. And this is just really a lot of different proxies for the major components of the economy, the S&P 500, Chinese stocks, Indian stocks, auto stocks, housing stocks, consumer, copper, oil, silver, gold, U.S. Treasuries, and the U.S. dollar. I'm trying to determine in my own mind whether we are expanding, whether the system prices are inflating or deflating, and certainly we see the waterfall decline with Lehman Brothers, following Lehman Brothers in 2008, and then again a reflation play when the government, when Bernanke's pumped in huge amounts of money, and as Ian Gordon was suggesting a while ago, a grand amount of speculation in the commodities markets. But the problem that I have is I look at these components in my IDW, the items that, if we had a healthy economy, the items that should be leading would not be the commodity items. Those should come late in the cycle. We should see things like the housing and auto sectors doing very well. They would pull up then and ultimately create demand for the commodities, and energy and those kind of things would grow with the economy. What we're seeing is the commodities booming way ahead of the economy, which to me tells me that we're in a grand speculative bubble. And most of this money that Mr. Bernanke is putting into the system is really going into speculation. Wall Street, the successful stock pickers and the commodity players are getting rich. In the meantime, the middle American, the people of the average Americans are having more and more difficulty making ends meet as their food price, cost of energy goes up. These are just some of the guests that I've had on my radio show. The staunch deflationists at the top, I've had Robert Prechter, Ian Gordon, Bob Hoy, Mish Shedlack, there's a fund manager from Zurich, and several others. And then on the inflationary side, I've had Ron Paul, Mark Faber, Doug Casey. Richard Mayberry is going to be my guest next week on my show. James Turk, you would know. And then there's some of us that are sort of agnostic about it all, and I'd put Eric Sprott there possibly. and myself and some other people as well. But the main thing that I would like to point out that I believe is absolutely true is that the policies now are as certainly failing as much as they did in the 1930s. You know, for those that give Roosevelt credit for getting us out of the Depression, I think it's a lot of hogwash, because his own Secretary of the Treasury said that, in fact, our policies have created, we have as much unemployment after 8 years of the Roosevelt administration as we had when we started, and in fact, all we have is a lot of extra debt. And that's essentially, historian Burton Folsom, who's also been on my radio show, has published a book, New Deal or Raw Deal, which I would highly recommend for those of you who care to look in or to understand what's really going on as opposed to what our mainstream is telling us. Howard Davidowitz has been on my show. Many of you who are here in New York would know Howard. He's on Bloomberg frequently. Howard is a retail expert, and he points out that it's really the top 20% of the population is doing well or doing better. The bottom 80% of Americans are becoming more poor, or their living standards are shrinking. And he sees this with the top retail stores doing extremely well, and the very bottom, the dollar stores, the penny stores, the stores where middle classes are being shoved down to, doing very well. So this is not good, I think, for any kind of hope of getting out of this funk that we're in. In a couple of weeks, I'm going to have Professor Robert Auerbach on my show, and he was a former Federal Reserve official. He also was a populist who had worked for Henry Gonzalez in the banking committee, in the House Banking Committee. I saw him on Bloomberg the other day and decided I really wanted to get this guy on my show. He's talking about $1.5 trillion that are sitting in the Federal Reserve, are in the banking system, that the Federal Reserve essentially gifted to the banks. The banks are making $10 billion a year on this, but they're not lending it out. Now, Ian Gordon talked a little while ago about the banks not lending, and they're not lending just like the 1930s because they can't find credit-worthy borrowers. In other words, as Ian said, this system, this credit inflation comes to an end when when additional debt that you take on cannot be repaid, and that's where I think we're at right now. Now, I watched something else very closely called the 52-week global U.S. dollar liquidity measure. It was something Charlie Clow at Merrill Lynch brought to my attention during the Asian crisis. And I track this because it more or less shows the bubbles. We are in a bubble economy. It's not a healthy economy. It's an economy that has to grow, quote unquote, grow by fictitious money that's pumped into the system. So more and more we're having bubbles. And we had the tech bubble that ended in 2000. And then the housing bubble that was created with massive amounts of money. The point is that as the money's pumped in, we have these massive bubbles, and now I think we have a treasury bubble, we have a sovereign debt bubble, we have also a commodity bubble that I believe is about to, it may be about to collapse, and I think we may be seeing the start of it right now. The point is that when the credit systems fail, people sell the things they're able to sell. They sell their illiquid assets. They sell things that they wanted most when the system was expanding, speculative items, and they go to gold and they go to paper money because that is the safest store of value, and also because they're forced to liquidate because they've got to pay their debts. And so this is John Exter's inverted pyramid, credit pyramid. It shows what happens. So gold is at the bottom. It's the most liquid and the most trusted asset, and this is what's happening right now around the world. The start of it. I don't think we've seen the end of it by any means yet. This is just a chart that shows the monthly average of gold. This is a glorious bull market. This is in nominal prices, of course, and we're looking at 20 and 40-month moving averages. 10 straight years the price of gold has been higher. But here's what really matters is the purchasing power of gold. And I measure the price of gold versus the Rogers Raw Material Fund. And right before Lehman Brothers in August of 2008, it was about 17%. An ounce of gold would buy about 17% of the Rogers Raw Materials Fund. That skyrocketed to 44% by March of 2009. And this is really the key to the profits, I think, that are really starting to boom here with the mining companies. I hope they don't take... Okay, Bob Hoy here. I've got 2 minutes left. Bob Hoy has historically looked at the last... he figures this is the 6th major credit contraction in the last 300 years. And each and every time we've seen this happen, the real price of gold has risen dramatically. Homestake. $1,000 invested in a home stake during the 1930s. That's the top line. If you put 15% of your portfolio in home stake and 85 in the Dow, you would have avoided losing money most of the time during the 1980s. Here are earnings of some of the top gold producers right now. In 2008, a little over $5. In 2009, about $6. Well, here, I'll just show you the next slide. These are the companies. These are household name gold producers, and you'll just see the enormous amount of growth in earnings from $5.77 to $7 to $13 this year. And the analysts are projecting $18.88, if I can read the slide, and $21 going forward over the next 2 years. So the major gold producers are really doing very, very well. And that has profound significance on the companies that are here in this place. Here are some of them that are on my recommendation list: Alexco, Barkerville Gold, Athabasca, Merrick's Gold, Palangio Exploration, Sand Gold, and a couple of radio sponsors that I'm taking a real good look at, Auriga Gold and Trevally Mining Corp. There are so many. This is the bull market of a lifetime because the real price of gold is rising. The real price of gold is rising because people are losing confidence in the credit. The credit system is imploding. More debt cannot be taken on. There's fear internationally. Americans will be the last time to figure it out. Those of you who are here are way ahead of most Americans, but most Americans believe what they hear on CNBC. They believe the mainstream media. They keep their confidence in paper. It's a gigantic con game to keep you away from this place and away from gold shares. Use your head. Think about what's really going on, not what the establishment wants you to think is going on, and that's what we talk about.